All right, so stocks and bonds are not liking the reaction on today's US inflation report. The US CPI numbers came out today at 8:30 a.m., higher than expected. When we look at the numbers, if we look at the year-over-year core number that takes out the volatile gasoline numbers, we see that the number came in at 3.9%. That's year over year. That's the core number, and the expected was 3.7%. If we look at the year over year headline number, this is the number that everyone talks about, Biden, the news, media, etc., etc. That number came in at 3.1%. The expectation was that this number was expected to go at a number at 2.9%. So there was an expectation that the inflation number was expected to go at the two-handle number to finally break below the 3% level, but that did not happen. When we look at the month-over-month number for the headline number, came in at 0.3% versus the expected of 0.2%. And when we look at the core CPI month-over-month number, coming at 0.4% versus 0.3% expected. So what contributed to the increase? Well, when you go on the BLS government website, it talks about here in the second paragraph and the third one as well, saying the index for shelter continued to rise in January. So shelter was a big component of the increase in the CPI, increasing 0.6% and contributing over 2/3 of the monthly all items increase. The food index increased 0.4% in January, as the food at home increased 0.4%, and the food away from home index rose to 0.5% over the month. In contrast, the energy index fell 0.9% over the month, due in large to part decline in the gasoline index. So we saw shelter, right? Your rent, your home, cost of living in your house has gone up. We saw food, even at home, especially if you're going to the grocery stores, still moving up, still higher than expected. Those were the main contributors to the CPI numbers. The index for all items less food and energy, looking at the core number, indexes which increased in January include shelter, motor vehicle insurance, and medical care. So medical care in the US, motor vehicle insurance, and shelter again contributed to the higher core number. The index for used cars and trucks and index for apparel were among those decreased over the month. So if you're looking for used cars and trucks, guess what? Those the prices are declining in that area, and you should see a continuation of this area to continue to decline. We've been seeing that for a couple of months, that used cars and trucks have been declining. Index for apparel also. So if you're going shopping in this area, you can expect, or you should expect from the dealers, some good discounts. Now, when we look at this report, right, if we look at it from a holistic point of view, if we look at how this number has been playing out in the last couple of months, let's start with looking at year over year numbers, and let's look at the headline year over year number first. So the headline year over year number has been trending sideways, okay? I know a lot of people on probably Twitter and whatnot will say, oh, look, the number is lower compared to November, or compared to last month or December, whatever the case may be, right? Well, if you go back to all the way to June, July of last year, the number has actually been in a range. It's been ranging between a high level of 3.7% to a low level of 3%. And the number that actually came today was 3.1%. Okay, so the number's been in this range for a couple of months, which is telling you what? Yes, we've been in disinflation. Disinflation means that prices are not rising as expected. They're rising, but the rise is declining. right? If you remember back in 2022, the peak of inflation was sitting around 9.1%. We've come down all the way to 3.1%. Yes, we have made progress. However, from June, July of last year, the headline inflation numbers that includes gasoline, includes shelter and all these components have been ranging sideways, showing the stickiness, showing that there hasn't been much progress, showing that everyone was expecting the two handle in inflation, meaning 2 point something percent, breaking that low of 3.1% did not come. Hence why we saw the Federal Reserve, the FOMC, many weeks back, where they discussed that they want to see more continuous data of inflation showing weakness and coming down. Let's look at how this number also looks at when we take in consider of core inflation. Right? When we take core inflation, it's basically taking out gasoline, the volatile numbers. So we know that the headline number is lower than the core number because gasoline is putting downward pressure on the inflation number being reported on the headline. But if we take that gasoline component out and strip it out and we look at just the rest of the numbers there, which is the core number, the core CPI number year over year, the number sits around 3.9%. The number before that was also 3.9%. Number before that was 4%, December of 2023. When we look at November of 2023, 4%. When we look at October of 2023, 4.1%. So it has been declining, the core number, but we see from the decline of the core number, it's starting to plateau here. So you can imagine we had, this is, let's say, the peak of the core number, which was around 6.6%, right? It is now a little bit plateauing. You're seeing a flatness in the core number. So you're not seeing that further decline that people wanted to see. We're seeing the flattening of this number, meaning the stickiness, right? Meaning that inflation is sticking around. This number is sticking around the 3.9% level, the 3 to 4%. It's having a tough time to break a new low in its numbers. And again, goes back to what Powell was saying. They want to see continuation of weaker data. Hence why they basically threw cold water on any idea of rate cuts coming in March. Now, when you look at what the markets are pricing in, the markets are pricing in no rate cuts in March. However, the rate cuts that were expected to come in March before the CPI, the markets were expecting May you were going to see rate cuts. And the probability of rate cuts in May has also dropped from plus 50% down to, I believe, 30-40%. So now where does the rate cuts, where does the market see where rate cuts are coming? The market sees that rate cuts could come in June, July, and that sits around more than about 50, 60, 70%. So that's fully priced in for June, July, the rate cut to start, and that's where the Feds, some of the Fed members align of where the first rate cut could come in, which is June, July, right? Happens to be before elections also in the US. Now, when we look at the month over month numbers, right, we also see the numbers have been ranging as well since 2022. This is the core number. When we look at also the headline number, let's take a look here. The headline number, I can suspect that number is also have been ranging, again showing you the stickiness, right? 4.4% been ranging for some time. We haven't seen the break below the 0.2%, right? So again, more rangy type of numbers. Now, also another number that is not reported and talked about, it's called the super core CPI number. The super core CPI number is basically taking core inflation, core CPI, and taking out the shelter component. So when you take out the shelter component, the Fed calls that the super core number, and the Fed said we're watching the super core number, and if that number continues to decline, that's a good sign. If you remember my opinions about the super core number, I think it's quite bogus because shelter is a very important component, and it's a big component, a contributing factor to the stickiness, one of the contributing factors to the stickiness of inflation. And if we take out the number and say, oh look, the economy or inflation is doing better, you're just kind of nitpicking what you want in the data to make yourself look good. But even with doing that and taking out the shelter component, the core, super core number came in higher as well. So the super core number usually consists of services, and that number came in hotter than expected, which is telling us what? They're not doing a good job in terms of trying to attain this inflation. Now again, holistically, when we look at things are still ranging for some time, which is creating that stickiness of inflation. In order for it to break lower and for progress to continue, we want to see that stickiness erode and go. And when does that come in? Well, we will see. We will have to analyze the next coming CPI inflation data to determine if this number is going to finally hit the 2 handle rather than sitting around the 3% level. And if that's the case, then you can see more of a higher chance of some sort of rate cuts coming soon, unless there is some sort of big black swan event, some sort of crisis that comes in earlier, and the Fed might step in to do something about it. Because we did hear from the Fed, the FOMC, say that they are ready and willing to cut rates if the job market gets worse off. So anyways, this is my take on the inflation numbers that came out. The equity markets were basically selling off initially, picked back up, and then we're seeing some selling pressure again in the equity markets. The bond markets, on the other hand, has been just nothing but selling because of higher rates. Pushing out the rate cuts basically brings higher yields in bonds, which pushes the price lower. This will all change very quickly if we start to get those weaker CPI numbers and more of the rate cuts being priced in. But right now, the markets are now pricing in. We moved from rate cuts coming in March to now the market's pricing in possibility June, July. So let me know what you guys think. Leave a comment below, subscribe, hit the like button, bell icon to be notified on the next video, and I'll see you guys around. Cheers, bye.